start us off?
Well, I mean, I'm happy to start. We, for the
Certainly.
most part, in the beginning of the week, we had generally consolidated markets, but there's been one consistent theme, which is what I call risk aversion. Investors are nervous. Equities have been struggling. They've been mostly lower, and I think that's indicative of all the data that we've seen, which is showing that the cracks are growing in the U.S. economy. And we had a horrendous Philly Fed survey, and we've got the Federal Reserve meeting coming up in 2 weeks. And so everyone's starting to wonder, will that cause the Fed to be on hold? Or even if they raise interest rates, are they going to really dial back that hawkishness? But I think, what was really interesting is I posted an image on my Twitter feed. I think it was from Bloomberg it was from Bloomberg, showing recession probabilities worldwide in 2023. And it had the US recession at 65%. And the New Zealand recession at 70%, UK recession at 75%, which, these are pretty high numbers, Corey.
Sure, very high.
I think, before, equities were really roaring, and now I think everyone's starting to feel that uncertainty, and that's what's
so we're definitely a risk-off environment. You're saying?
Yes, that's a main theme in the markets.
What are we looking for this week?
Sorry, for those of you that are just joining us on Twitter Spaces, I'm going to post the YouTube link. We're actually video streaming on YouTube, so we're going to be showing charts in a little bit. So make sure that you log on to the YouTube link, the Surge YouTube link to watch. In terms of next week, the big events next week is we've got 3 things going on. Number one, it's the BOJ meeting, which is pretty much a non-event because they're not doing anything. Number 2, more importantly, is Q1 GDP for the US, and number 3, Q1 GDP for the Eurozone. So these are the flash advanced GDPs. Always, the first release is always the most important. And I think everyone's going to be watching that quite closely because growth is on everyone's minds, especially after this week's numbers. So I think that that plus, I forgot to mention, personal income, personal spending, and the Fed's number one favorite inflation indicator, the PCE deflator, is coming out. So we got a lot of pretty important data going into the FOMC meeting the following week, I believe. And, that's going to be much more market moving, I think.
Right, absolutely. And are we, in your guys' estimation, are you looking for chop? Are you looking for direction? Are you staying out? What are you giving, and what are you recommending for traders coming into these more volatile times?
Boris, do you want to add in, or?
It's just chop beyond belief. We're literally flushing up, down, up, down. It's, this is actually the best market to trade range I've seen in a long time. And it's literally the worst market to trade trend this whole year, maybe, even longer. I mean, literally the worst market to trade trend. There is no, basically, this is the perfect market to buy bottoms, sell tops if you're in a range trading mode. Unfortunately, most of our strategies and everything that I'm oriented to is much more trend oriented these days. And it's been a tremendous challenge. We're barely, I'm lucky to basically stayed even most of the week this week. The markets, I think, fundamentally are in a wait and see mode. There's very little direction from the Fed and from policymakers at this point. There's a huge tug of war between what Kathy was talking about in terms of the recessionary impulse and the still growth impulse on the labor front, which is creating even tighter credit conditions. And, you're just getting really tremendously intense chop conditions. I mean, I think in some ways, this is a great example of how you sort of have to be very flexible and maybe completely change your mindset. This is maybe the market where you just want to start selling tops, buying bottoms until it stops working, or step back.
So,
right.
Another reason why it could be more challenging is because we do have a lot of this event risk for the U.S. That will give us more information going into the Fed meeting. But the problem is that they're happening on Thursday and Friday, kind of all bunched up in 2 days. So the front of the week is going to be much more of a focus on the euro, because with the German IFO report, but probably just kind of consolidation. Because remember, 2 weeks before the Fed meeting is what we call the quiet period. We've heard from pretty much, all the Fed officials that will be speaking already. And, it's a tinge of dovishness. I think it's definitely clear that they're sharing the concerns of the market. But, we won't get much in the beginning of the week. It won't be until Thursday and Friday that we get those GDP numbers first. And then on Friday, that PCE deflator we're all watching. So yes, in the beginning of the week, it could be more chop and consolidation. But I think on Thursday and Friday, we can get some very telling numbers that's going to allow investors to really set their positions going into the following week's Fed meeting and to basically decide how they want to be positioned. So, as Boris said, with these markets, you have to really trade, carefully. I mean, it's kind of like this week where, for me, in the beginning of the week, it was kind of tough trading because it was very, we weren't getting any continuations. We were just getting a little bit of movement, and it just wasn't enough to hit my profit targets. And it completely U-turned. And as Boris said, perfect for picking tops and bottoms traders. But then at the end of the week, on Thursday and Friday, we came back. We came back because we got some of these bigger trending moves. And I think that's going to be the case next week, too. If we're lucky, maybe we'll get the trend to follow through for the whole week. Maybe some people start to position in advance. But chances are, given the calendar, and given that everything's backloaded, I think that it's going to be very similar where we get backloaded price action. And just so I can remind everyone who's on Twitter Spaces, we're streaming live on YouTube. So if you want to see us, see our charts, see what we're talking about, please come on to the YouTube link and not just stay on Twitter Spaces.
Now, Kathy, we've seen incidences like this before where we're going into Fed meetings and there was risk-off environments and we got bad data and the markets largely shrugged it off. Going out a couple weeks from here, do you see a continuation of that, or do you see some real fear start to set in, maybe start to see some capitulation in the equities markets?
I think globally we're starting to see more significant contraction in spending. We saw that with the UK data this morning. And I think, anecdotally, I posted a poll on Twitter last week, I think. And I asked people if they were tightening the belts, given, what's happening around the world. And I think 75% said, that they do think a slowdown is happening and they will be, cutting back on their expenses. And I think, this was maybe 100-something people who participated. So not, a huge sample, but a good sample. And I think
I've seen it too.
That's going to show up in the data. That's going to show up and is showing up in the UK data. It's going to show up in the US data, especially around this time of year when it's tax season and, money's going out for a lot of people. And just, bills are being paid. I think that those numbers, and that weakness in those numbers that are either happening right now or going to be happening in the next month is going to add to the concern in the markets, add to the weakness in stocks, add to the risk aversion, and, maybe lifts gold.
Is there a delay in that number, consumer spending, or is that typically priced in immediately?
Well,
no, there's a delay.
Yeah, the data is always delayed by a month. And not only is it delayed by a month, but usually when we get the first release of the data, it's the first 2 weeks that they sample and they kind of project it for the next 2 weeks. And that's why we have revisions. That's a really good question that people don't really think about, Corey, which is that, when you get a number, it's usually the first 2 weeks of the survey period. And then they revise it once you get the full month number. So yes, it's delayed.
Got it. Thank you.
Gold just had a huge collapse of 30 points in the last half hour. So gold has hardly been a bastion of strength so far. There literally is, honestly, the irony of the whole thing is we've been doing a little bit of news trading of FX in my live room. That's been the one thing that's been working like a charm. Nothing else has been working. It seems to.
So I want to throw out there, some of you who are listening, who are trading, are pure technicians who say, I don't watch news, I don't care about fundamentals. Everything is baked into the price, which I think is complete BS. And today's price action is an example of that. Boris said, gold is down 30 points, maybe you didn't look at the calendar, Boris, but we had the flash PMIs from the US come out. They came out stronger, shot the US dollar up. And that's why, the dollar is up, dollar yen's up. And that's why gold, suddenly dropped. And so fundamentals matter. Minimally, you should be aware as a trader what's on the calendar so that you're not kind of walking into a train wreck. and understand what's causing the movements in the markets. There's a very good reason why gold collapsed at a very specific time, which was right when the U.S. PMIs came out. It jumped up to 2,000, it completely rejected it, and dropped 30 points right off the data.
Yeah, Kay is absolutely right. I did not see I was actually live trading, so I didn't see the PMIs. But yes, and the other thing is, in the old times when money was free, there really was only like one trade, which was risk on, risk off, right? Easy money conditions, like everything got bought. Doesn't matter what the data was, because nobody cared about data because money was free. Money is no longer free, right? And as a matter of fact, one of the interesting things I read today was that money market funds have been the greatest money inflows of all the mutual funds. So like people are putting their money in cash, which has been the best return around, right? And so once you get into that mode where money is not free, you get a huge amount of individual news mattering, individual stocks mattering. It all comes down to dispersion in every single market, which is that's actually Kathy's specialty. Should really hopefully be very, very good for fundamental trading. But yes, like all the fundamental traders who bemoan the idea there was just one single trade for the last decade, that's not going to be happening. You're gonna it's going to be day by day, very idiosyncratic, very individual type of moves, and that maybe is another interesting thing to consider when you're trading. It's one of the reasons why news trading has been working for us, but broad flow trading has not, because there's not been any kind of really consistent flow.
So would you say we're going into a market that's going to favor a successful trader as a term to a long-term investor?
It's good. I think we're going to the market that's going to favor a trader that's really well positioned and well informed every single day, where information is going to matter. Like in the old days, information did not matter. The only thing that mattered was flows. If you caught the trend, you caught the flow, you're fine. Now every day there'll be a different flow because there'll be different information.
So externalities are going to be super important at this point.
Yeah, I think so.
Staying on top of them.
It's a lot to take in. It is. It's a lot more to take in. It's actually a lot more difficult to succeed in, which is why you want somebody on your side who understands these kind of things.
Speaking of that, I think it's important to have someone on your side and also have the tools that are on your side. So we've been talking gold this morning, and I just want to share my chart if you don't mind, Corey. Let me
certainly
share my gold chart. And for those of you that are on Twitter Spaces, there's quite a bit of you. Please go on to the YouTube link, because that's where you're going to see my charts. So we're looking at gold right now. And, some of you may have said, gold's been choppy all week. And, it really has been. I have to admit that. But if you, were using some of the indicators that are included in your Surge audition, for those of you that are doing the audition for the first time, you get our proprietary indicators that Boris and I have developed. You will be correctly keyed into the right direction, the right trade. So you look at my gold chart right now, and I've got my zip indicator on the chart. And so the way you read the zip indicator is that when the instrument, in this case gold, is below the indicator line and the background is red, it's in what I call the sell zone. If gold is above the indicator line and the background is green, it is in my buy zone. So you can see here that gold moved into the sell zone. At 1 a.m., for those of you that are, we have a lot of European traders. For those of you that saw the zip sell signal in gold at 1 a.m., which is the time, right before the London Open, that would have positioned you into the short trade. Even if you didn't, and you're a U.S. trader, and you came in during the North American session, let's say around 6 a.m., you're still in the sell zone because we're in the red area. So it indicates that you should be leaning towards, selling gold, not buying gold. And when we finally got the data come out, boom, you can see this beautiful trade. So, what I'm trying to tell you is that it's really important to have the right tools on your side. Number one, you've got to know what's coming out, have the right trading calendar, you can follow me on Twitter. I post about some of the news events that are coming out, and you've got to have, indicators that basically, just take away all of the noise, because there's so much, noise and indicators and charts and technical analysis tools that you could use, but you want the ones that are clean and easy to interpret, so it reduces impulsiveness. So for me, I would not have been looking to buy gold at all during today, because we were in the sell zone. So be looking to sell gold. Now I'm going to show you a relatively choppy price chart in euro dollar.
Kathy, before you leave that chart, can I ask you a couple quick questions? Thank you. And for those of you guys who don't know, Kathy mentioned it earlier, whenever you audition, you do get a free 30-day membership to BK Trading along with all of their indicators. So definitely take advantage of that. You can find it on the website and in all of your email information. But Kathy, going to this chart, let's take a look at it. I know that it switched over and now we're in a sell zone. Can you talk a little bit about entry and exit? How would you identify where the entry and exits are? And are you just getting in because you're in the sell, or are you looking for other confluences?
So very good question. The entry itself is already, the best entry is already identified by the candle that shifts to the white color, which I believe, if you can't see my mouse here, let me see if I can add a highlighter of some sort. Highlighter. Okay. This right here. So this right here, which I think should come up soon on your chart that you're watching, is the white candle. That is the pure zip sell signal. Now here we get a little tiny one that doesn't work out, which is okay because those strategies is 100%. But look at this one over here on the left-hand side. Another beautiful zip sell signal. So the entry signal is already built into the indicator. This is what we call the classic zip sell signal, which is that when you see the white candle and it's at, what I like to call a active market hour, like 1 a.m. or like not like, the dull Asia session right before the London Open, that's when it's a good time to trade. Now, I also trade, because obviously I'm not up at 1 a.m. I trade the early New York Open at 6 a.m. So typically, at 6 a.m., the whole idea is that there is additional continuation. It may not be a lot. So for example, let me highlight another area, the 6 a.m. area. Actually, let me draw an arrow. This is the 6 a.m. candle on this part of the chart. And I'm going to put the other 6 a.m., which I believe is right over here. Right over here. And so even if you entered at 6 a.m., the New York Open or the early New York Open, you won't get a huge amount. You won't get the same degree of magnitude and move in gold, but you'll still get a little bit of continuation. And sometimes, depending on the data, you might get a more significant continuation. And so there are a couple different ways to trade. This, what I circled, is the pure and the best time to trade. That's the real signal. And then my arrows are where the variations depending upon your time of day.
So you would get in any time during that white candle?
Well, though you want to get the close, the best trade is to get in when the candle closes white. And you can
got it. Okay, so right after that candle closes white.
Yeah, you can set alerts on the indicator, and that will alert you when that happens.
So for everybody, all the Surge people out there who are looking for something to trade, this sounds extremely easy. Essentially, you're looking for the candle to turn white. You've got your entry signal. Go ahead and take your entry. And then I presume we'll have something similar for our exit.
So exit is more fluid.
Okay.
Exit with the strategy is basically, usually, with gold, we exit at $10 or so. With currencies, depending on the strategy, we exit between 20 to 60 pips. Usually we have a first target and a second target for exit. So, but, the point is to give you the entry signal. And then, with our traders in the room, we provide different, exit signals. And
got
Boris,
it. So we manage the
right?
position.
Boris also trades gold in his live room.
Yeah, we do, occasionally. But not with the indicator. We're sort of traded, essentially on a timed basis, because there are certain times of the day when gold really starts to move. Like, for example, news flow. Like we could have traded gold using our news flow trade. I can actually go through a couple of news trades if you guys want me to.
Yeah, please, absolutely.
Okay, so you know what? Give me just 1 second, Kay. Why don't you?
So as all of you are waiting, for those of you that are in Twitter Spaces, make sure you're going onto the YouTube stream to see the charts that we want to show you. And if you have questions, you can drop it in YouTube or you can drop it into Twitter Spaces and we'll answer them live.
Okay, I'm just because my screen is huge and I need to scale it up to the proper conditions. Just bear with me 1 second. It's just, and it's also it's really TradingView is really stressing out today. Okay, so let's look at. I'm gonna if you don't mind. Well, let's take a look at gold. Okay, how would I have traded gold today? Okay. All right, very good. Let me share my screen. Share screen. Okay. All right. So I'm going to get it a little bit bigger because I know my screen is just sort of I have a double screen, so it kind of stretches everything out. Is this a little bit better visible?
Yeah, it's good.
Yeah.
Okay. So we have, this isn't really essentially how my algo was originally designed, but it seems to have an incredible ability to do so. One of the great things about trading is, sometimes serendipity, if you're open to possibilities, you can find new opportunities for making money. So my bounce indicator just essentially is supposed to trade price action during the day, but we've been able to retrofit it and adapt it to trading news flow. And I'll explain to you exactly how that works. So first of all, just like Kathy, I also have green and red areas. Those are areas obviously of, selling intensity and buying intensity, right? So that's pretty obvious. However, in addition to that, I also have, as you can see, the green area, which is the highest high of the day, the red line, which is the lowest low of the day, and the midpoint line, And the way we define trend during the day is if prices are above the midpoint, we're buyers. If prices are below the midpoint, we're sellers. And we have a sort of a market entry structure, which is literally, I'm not kidding you, as simple as this. If we're above the midpoint and the candle is green, we're buying. If we're below the midpoint and the candle is red, we are selling. So if there is just to give you an idea, excuse me, back to spring allergies in New York. Just to give you an idea, I would not be entering any of these green candles below the midpoint because they're green candles. But I'm entering on any candle that is red. Okay, it's just that simple. So we're selling momentum. So our news trade is structured on a 1 minute chart. This is a 1 minute chart, and obviously bounce can go on other. We trade the 1 minute chart basically, but bounce can go on multiple time frames. Is the following: here's the news event. 9:45 is the news event, right? And let's say we trade the news event against the gold with the PMI data. We let the news event happen, whatever is the reaction. So in this particular case, the reaction would be, I'm going to set this up. News is traded at, we traded for basically $2, right? $2 target, $2 stop. I think it's make sure that the ticks are correct. Yeah, that's correct. Okay. So in this particular case, what would happen is we would sell, news comes out, price now is below the midpoint. So it's a negative trend. We're selling. Right, so we would sell, and obviously, it's very, very volatile. So this is what we do to fight volatility. We sell this at 87, right? We're going to get stopped out right away because we have a $2 stop, very, very tight stop. It doesn't quite go to our target. We get stopped out. However, the algo is programmed to if the conditions remain the same, to trade again and to trade again and to trade again. Give us 4 chances. And this is what we do that makes it very different. Most people will just simply get stopped out and walk away. That's it. But markets really require perseverance. And if you stay with the idea, you very often get rewarded. So in this particular case, we get stopped out on the first trade. We enter the second trade, which is right over here. This is the second red candle. And then it's just smooth sailing. We get done on the second trade. You could trade it for a lot more than 2 points. 2 points is sort of like our usual non-news. Generally we're trying to scalp the news, so we're not getting greedy. It's usually we use 10 points on currencies. So on euro, just to give you an example, today was it's been a relatively light day as far as news flow, but there was UK retail sales today at 2 a.m. this morning, and this is how we would have traded it. And this is the other thing that's incredibly important to understand: flexibility. So this. I'm going to just pull up the pound for you to show you. So I'm going to go to two.
Before you leave that the previous gold chart, is that algo included with the BK membership as well?
It's if you become an annual member of BK, you get the algo. But all of the tactics and strategies we teach you every day, you could do them manually if you wanted to. But obviously, everybody.
Boris live trades this every single day. So as a part of your BK membership, courtesy of Surge, you can join the live trading session that Boris has at 9:30 a.m. New York time. Is it Boris?
9:25. We have now started to move it to 5 before, because we have to set the algo up 5 minutes beforehand, so that because we trade the U.S. Open right away.
So you get that. You also get the Discord stream with the trades that you can follow. And if you become a annual member, a VIP member, you can get the algo that will trade it automatically for you. But it's, just to get started, you'll get to live trade, and you'll get the trade ideas, and you'll get the trading view indicator.
Excellent. So you'd be able to follow that along manually.
Yes.
Yeah. And that's, usually what happens is people follow it along manually. They go, oh, this is kind of cool. And then they get serious. And then they become degenerates. That's my group. We're very proudly call ourselves degenerates. We even have our own little degen tokens. And, everybody trades with me every single day. So it's a really nice, great group from all across the world. Everybody's very supportive. You have questions, people will answer. People have interesting variations on the theme. Some people trade very differently than I do. So there's it's not just simply, it's a real collaborative space, which is really fun.
That's great. Trading community so important.
Very much so.
And it's a great time of the day. 9:25 a.m. New York time, right before the New York equity market open. It's a perfect time for a lot of traders.
Right. If you're in Asia, it's at night. You're relaxed. If you're in Europe, it's lunchtime. Like I have a lot of people are basically eating lunch and trading with me. Yeah, Asians are after dinner, and then everybody in New York is trading with me. The only people that really suffer are the West Coast people. But hey,
right.
I'm going to the West Coast this week, so I'll be there with you. Anyways, so let me run you through, just kind of to make you understand why this is such an interesting tactic and strategy.
Yes.
So we have retail sales coming out right now. Again, we don't have an opinion on retail. We don't even interpret the retail sales. We don't care if it's good or bad. What we're looking for is directionality, not direction, but directionality. Directionality is the ability of price to just move either up or down, not in one particular way. So I don't have a bias, right? So that's very, very important. Neither does the algo. The algo does not have a bias either. And this is where it gets super interesting. So in this particular case, remember, we're above the midpoint, right? So the reaction is kind of tepid. It's not really a big news reaction. And we would actually be long, because the algo is programmed to be long above the midpoint. So I get long here, I get stopped out because I'm trading 10 points. It means 10 target. So I'm long 26, 36 target, 16 stop out, right? So I'm stopped at 16, right? And again, I'm still above the midpoint. I'm gonna get long again. And again, I get stopped out until I get to this point. Now I'm negative trend. Now the market has really expressed its view that this news is actually not positive, it's negative. And the algo completely switches tracks. And now it goes from buying to selling. It sells the 40s, right? Sells the 120, excuse me, not the 40s, 124.02 or 124.01. Stop is going to be like around 11. So well above this. And it resolves itself on the third try right over here. So
and that was see the momentum shift in the background of the chart. It shifts from green to red. So visually, it's very easy to see that. And keeping things simple is really what we try to do.
Correct. And then one last trade. I did not trade this, but a lot of people in my room traded this today. We had Canadian retail sales today, 8:30, and that was like such an easy trade. I mean, it was just incredibly smooth. So again, that's not a big event, but it doesn't have to be, as long as it's sort of like complementary to the flow, right? So here's Canadian retail sales 8:30. I think it was I think it was. I honestly, I don't even
It
know what
was
it was.
mixed. The headline number was better, but the X autos was weaker. So ultimately, the market interpreted it to be, initially negative for CAD.
Right. So if it's initially negative for CAD, that's actually positive dollar CAD, right? Because it's all inverted. Just because I know a lot of people who are not familiar with FX go like it's weird, but it's inverted. It's inverted. So negative CAD, we're above the midpoint. So we're positive dollar CAD, negative Canadian dollar. We're positive US dollars. So what we would do is maybe here or maybe here. Regardless, it doesn't matter which price. Either we take the 30 or maybe we buy the 28s. So 18 is the stop. 38 is the target. It's taking a long, long time, but boom, we're resolving the first try. All because we're sort of consistent with what the market is telling us. The market is saying this news was mildly negative dollar Canada. We're a positive trend. We're above the midpoint of the day. The algo just simply goes with it, goes with the flow. 10 points. It's super easy. That's been one of the important things about trading is to especially on frustrating weeks like for me, like where no trend is working, is to focus on what's working, and if one aspect of your strategy is working, then pay attention to that. For the last 2 weeks, literally every single news trade we've done has resolved positively. We've just had complete and total positive feel for it. So this is it's like a heat-seeking missile. The algo just simply zeroes in like my little dog, which is a Jack Russell Terrier mix and will never let go of anything, and just will stay on that trade until it makes that 10 points.
Well, let me ask you this, guys. I want to get each of your perspectives on algo trading versus discretionary trading. If you give some commentary on those, because we do have a lot of people who are, they start with one, they go to the other, and they want to go back, and people are kind of confused between the two.
Yeah, that's a really great question, Corey, because that's really the difference between Boris and myself. I'm a discretionary trader. Boris is an algo trader. And, we both trade differently and we both trade profitably, but it is a very different way to approach the markets. I mean, I trade discretionary because I incorporate the fundamentals, the bigger pictures, the news, which is very hard to do when you've got a pure algo strategy. And as I showed you earlier, you can't be a pure technician and completely ignore the news. You've got to have, in my belief, in order to truly succeed, you have to use a fusion of both. So that's why I believe in discretionary trading. And also, a lot of times, you can't, at least for me, you can't code in the sentiment of the markets. And, that's also a very important part of my trading, which is every single day, the start of the session, I look at what this market sentiment is. And I look at, what is the Dow doing? What are US yields are doing? I guess I could create some fancy code that just, pulls in feeds from the other markets and, try to filter out the trades that are not a part of that. But I'm not that smart to do all the coding. Boris does all the coding. And so, that's why I prefer discretionary trading. But even though I trade discretionary, I'm still a rules-based trader. I still have a rules-based strategy that I follow, which is the zip trade. And I still have, what could be an algo, which is the zip strategy. I just filter out the trades that I will take based upon fundamentals, time of day, as well as market sentiment in order to pull out the what I call the highest accuracy trades.
Excellent. So you're using a fusion of the two, but mainly based on discretionary with a rule set and risk parameters already built into it.
Correct.
Excellent. And then, of course, we know Boris is mainly on the algo side, and he's I would imagine he also has his finger on the pulse of all of the fundamentals as well.
I do, and I think the keyword here is rules based. Algos are not a panacea. They are not a solution to all your problems, and they're certainly not going to auto trade you to profit heaven. They are there. The reason I use algos is to execute my rules. In other words, first of all, we trade much faster than Kathy does. Like, if you're trading 1 minute chart, you're trading for 10 points, you snooze, you lose. You snooze, you lose. With the U.S. Open, sometimes our trades can get resolved in a minute. And if you're trading without the algo, there's no way you're going to be able to execute it. So the most important value proposition of algorithmic trading is just simply execution, size, inventory management, stops and targets, all of that is completely taken care of for you. The second thing is that Kay is absolutely right. Algos are contingent, contextual on time of day, instrument, and least important is the actual strategy itself. I always say that the hierarchy of how our framework of how we trade is what is the most important, meaning what is the instrument you're going to trade, because some instruments are going to be very and this is where if you're trading news, you want to be trading the pound dollar. I mean, trading UK retail sales against gold wouldn't have done anything for you, right? So you choose the instrument, then you got to choose the time, and that's really, really important. So, for example, 90% of the time in the market, equity market as well as the forex market, is just noise. The best time to trade is market opens, because that's when you get the greatest concentration of eyeballs, and maybe markets closed also for everything else. But in the meantime, most of everything that you think is going to work is not going to work during the noise times. It works some days, but it will not work consistently. And then, as I said, the how is sort of the least important, in the sense that you see my how is literally buy the green candle, sell the red candle. Like, it couldn't be simpler, and yet it is brutally effective, because it's all part of a much bigger structure that really takes care of all the other details.
Excellent. Yeah, simplicity for most of the traders I've met and talked to is super important. Unless they're engineers in their professional life, then they like things a little more complicated.
Right. Then they like to do multivariate equations, and usually,
exactly.
And usually it always ends in a disaster. Right.
Kathy, do we have any questions on the YouTube stream? Any questions from viewers?
Yeah, we do. So one of the questions from Peter is, are there times when the entry forms as a false signal, and how frequent? Well, of course there are false signals in both my setup as well as Boris's. But there's two things to be aware of. Number one, we reduce false signals by isolating certain times of day that we trade. For example, I trade the New York Open, which is from 6 a.m. to about 9 a.m. New York time. And then I trade the Asia Open, which is from 8 p.m. to about 11 p.m. New York time. And those trades oftentimes will carry overnight. And we don't trade in between, because the problem with in between is, for me, is that you've got the New York equity market open. And so there could be news flow, adjustments based upon earnings, miscellaneous things that are happening that could affect the initial carry through momentum of the strategy. I also don't trade into the London close, because that's when we actually get fake outs and reversals. And we obviously don't trade after the European markets are closed, because it starts to get the dead period of the day. So knowing when to trade and when not to trade is the key to isolating, to reducing those false signals. And then, it's also about the overall, yes, there will be false signals, but with the ZIP, for example, we are accurate, I would say, 80% of the time. And so it's basically minimizing those false signals and, focusing on the overall performance of the strategy.
And what about from a risk management perspective there? So when we do get a false signal, are we quick to cut the loss?
I am. If I see the momentum moving in the opposite direction, I will cut my losses quickly.
I am every single trade I take has a predefined loss to it. And, generally, because remember, when you day trade, that's the other thing is, the more frequently you trade, let's say you trade 10 times a day, right? Then your loss should be no more than 10 basis points. To make people understand what that is that's $10 on 10,000, or $100 on 100,000. We trade with a $100,000 account, so it's 100,000. So if you're trading 100,000 eval, and you're going to do 10 trades a day, you should probably contain your loss to $100, 10 basis points. The reason why is because it's not at all inconceivable to have 5, 6, 7 losses in a row sometimes, especially when you do more frequently you trade. So you can, it builds up. Now, if you're trading 1%, just to give you an idea, if you're trading 1% risk per trade, and you do 10 trades, and you hit like 4 or 5 losses in a row, you're blown out. You're literally drawn down on your account. You're done, because you have a 5% budget. So you have to, I like to give myself, like we sort of give ourselves, we sort of say, if the worst case scenario happens 6 times in a row, do we have enough budget to survive the drawdown, right? And then the answer is, so like maximum, what I want to do is my maximum loss should be 750 basis points. No, not 775 basis points. Sorry, welcome to New York. It should be, basically 3/4 of 1%. So $750 on 100,000. So like worst case scenario, I'm like deep into this position and it all gets blown out. I'm going to lose 750. And if that happens 5 consecutive times in a row, I'm still going to have enough money to survive the maximum drawdown. Now that's very conservative. You could probably adjust that, but not much. It's not much.
Right.
If you have the other attitude of like, hey, I just need to make 10 trades at 1%, $10,000 trades at 1% to get myself funded, you're much more likely to get blown out. I mean, you could get lucky sometimes and hit 10 trades in a row, but you'll never be able to hold on to the account after that. That's the other thing is, you may get lucky to get funded, but you'll never hold on to the account. I noticed, by the way, that's an interesting statistic that there are a lot of people that will get funded that won't be able to hold on to the account. Like, I'm looking at other prop shops that publish their statistics precisely because of this methodology. You want to be in a situation that will keep you funded for, as long as you want to go. And that means very, very conservative stops.
So do you think having a similar strategy on the eval and the live funded portion is appropriate? Because we do see a lot of people change their strategy.
Yeah. I mean, the only, if I were to say anything is that the real money portion should be even more conservative than your
more
eval.
Conservative, right? Because now you're in the game.
Right. Because and what happens is everybody gets greedy and they want to make it. They want to, they may be a little bit more conservative, ironically enough, with the eval, and then they get really aggressive with real money because they want the money super fast, right?
Right.
And then that's just a road to perdition, right? Usually. So yeah, I mean, I think it's not complicated if you think it through ahead of time, and that's what we try and do. Remember, you have a certain budget. You have a $5,000 budget on a $100,000 account,
right?
If you blow it all at once, you can't play if you don't have the money. That's the most important part. There's
right.
always
So what I'm hearing is risk mitigation and loss prevention are top of mind here.
Well, always, and and with Kathy even more so. I mean, Kathy is brutal. She'll like if the trade isn't going her way, she'll cut it at 3 pips. Like if it's 3 pips out of the money, she's out. I'm out. Like as a matter of fact, one of her. It's an interesting approach, and you have to understand what she's doing because people sometimes like misunderstand it. She'll come into she'll have a strong idea on a trade, right? And it just won't work. Maybe there's a buyer, maybe there's a seller against the position. Who knows? She doesn't wait to find out that it's not going to work. She gets out. She'll wait patiently. It sets up again. She'll go again. Like she will go 2-3 times into a position until she gets the right toehold. Then she's made, until she's positive. Once she's positive, then she's going to ride it out. So you have to have, that kind of a mindset. It's all about just being very flexible. Everybody wants to win every single trade. And that's just, and nobody's more guilty of that than me, but it is a toxic mindset.
Right. Right. Absolutely.
So we have another good question about what are the best daily market news feeds to follow in order to stay on top of the developments. First of all, I think that, if you are trading, you should be on Twitter. Many of you are on Twitter Spaces. And I think, pretty much all the key information that you need to know will be reported from, News Squawk, Investing.com, Zero Hedge, and Forex Live. I think, if you got those 4 feeds on your Twitter and use something like TweetDeck, then anything important that you need to know will be said by one of these feeds. Those are my favorites. I don't know about you, Boris.
Forex Live. I'll a lot of times watch Reuters. I have a really love-hate relationship with Zero Hedge, so I don't. They're a Russian propaganda site, so I don't follow them. They're okay for news though. They will break news occasionally. I'm trying to think of like who do I think is a
you use
honestly,
News Squawk, right?
News Squawk is great. News Squawk and what's his name? Pip Squawk, I think. I forgot his Pip. I have to look it up on my thing. He's very good at doing news. But honestly, 90% of news is calendar driven. and it's really important to just simply know the calendar. It's very simple. Trading Economics is a great calendar. Kathy likes to use Daily FX, although I think that's for Americans there's some issue with the website now. MyFXBook.com calendar is great. Just for popping up. They have a applet. Like it goes to if you're a fiend like me, it goes to your iWatch, right? So like if I'm taking my daughter to school and I want to see the 8:30 release, I get it right on my iWatch.
Nice.
So you can get all of that done. It's most important to know what is it. Most of the news is actually planned, especially in FX. So unplanned news will hit Twitter right away, whether you have the news feed or not. Somebody will be tweeting it, and you'll see it very, very quickly. You'll also see it in price action. But it's more about being prepared. I think that's really kind of the takeaway that Kathy and I always talk about is just be prepared for the day. It takes 5-10 minutes to know, what's going to be important. In addition to it, so Kate, I wanted to ask you is, aside from the news events, what's really, really interesting is Fed speak, central bank speak. Where do you go to just kind of know who's going to be speaking when on what? Do you go to the central bank websites or?
No, just what you poo-pooed, the Daily FX calendar. The Daily FX calendar has, pretty much, all of the Fed speak that needs to be there, all the ECB speak. Okay. They list it out every single day. So you poo-pooed it, Boris, but it's there.
No, I wasn't poo-pooing it. I was just saying there's some problem with the U.S. Like they're blocking U.S. customers from watching it for whatever.
All you have to do is click on that check mark that says, I test that I am not in the U.S. Okay. And then it loads up the whole website.
As long as you're untruthful, you're good. Okay, that's fine.
Now, guys, with such a vast amount of information available so easily, so quickly, I'm sure 10, 15 years ago, you really had to dig for it. How do you kind of filter out what's important and what's not important?
Well, I mean, the easiest way, as I said, is, follow those news feeds. They'll tell you what's important and what's not important because they'll do the work for you. And, everyone's so busy. There's no need to reinvent the wheel. These guys, their job is to filter the news to the most important news. So if you're trading FX, you should be on Forex Live. If you're trading stocks or U.S. indices or gold, usually News Squawk is really good. Investing.com is really good too.
Excellent.
Yeah. So because in addition to the macro stuff, you also want to know, which big earnings are coming out. And then, that's important, but that's also everybody will post that. As far as what Kay was saying in terms of what's important, every calendar will have a red band on the important news flow. So like Trading Economics will have a red band on the important stuff. And my FX book will just simply say high priority. Everybody will have basically a red band on the important stuff. And that's all you really need to, worry about. And don't worry about the other thing is I think people make the other mistake is they get too minutia and they'll go, today Empire is coming out, or today durable goods is coming out. Is that tradable? No, not really. It's not tradable. There's like
come on. I mean, Empire and Philly were very tradable this week. They were huge market movers.
Yeah, Empire today was, but I'm just sort of trying to create. There's 20 or 30 economic indicators a month. There's only about 5. Like if you want to know what's important these days. First and foremost, inflation data. Okay, like if you're going to rank the 5 things you want to look at that are definitely going to move the market, 100% guaranteed going to move the market. Inflation data, that's number 1, right? Number 2, central bank decision, because that's obviously going to be derivative of the inflation data. Number 3 will be employment and wage data, because that's going to determine economic growth and inflation data. So those are top 3. After that, you would probably look at GDP. Not like the third or the fourth or the fifth, estimate of it, but just the first fresh estimate of GDP. And then number 5 to me would be retail sales / consumer sentiment, and stuff like that. Maybe you also want to look at, number 6, which is like the other component, is PMIs, or in the US, they're called ISMs. Those are industry surveys of how things are going, both on the services side and manufacturing side. That's really the major data that will move the market. And, now within that, you're also going to have central bankers. They're going to say something, and that's going to move the market, or the president's going to say something sometimes, and they may move the market. But, as far as economic data, those are the components you want to anchor around. So
Great, that's super helpful.
Yeah,
there's like 6 or 7 currencies, 5 or 6, events per month. That's like 30 events that you could trade,
So that's why next week, PCE deflator. Inflation is number one for the market's focus. PCE deflator is coming out next Friday. That's the number one report on next week's calendar.
Yeah, exactly. That's going to be, and that's end of the week next week.
Last week, you guys left us with some macro outlooks for the coming weeks and months, and oil was a big one. What are your thoughts on oil these days?
Yeah, I mean, oil ain't doing it, right? Oil is just everybody's like got excited about 80 oil. We were listen, we're still, I think, structurally bullish oil. I mean, I don't, if oil is at 50, we got much bigger problems than oil at 50.
Sure.
Oil at 50 means we are in deep recession. So what I think is fascinating is with the Saudi cut, with all of this China coming back online and everything else, still can't get up off the ground. Can't really rally above the 80s. And
Is this cracks in the consumer? Is that what we're seeing?
I think that's the main explanation, right, for the sell-off in oil. We've got the whole Saudi thing the Boris talked about last week that you have to keep your eyes on, and none of it mattered. I mean, this whole week we were in a downtrend zone because equities were kind of floundering, and I think it's back to exactly what we talked at the top of the talk, which is that worries about the U.S. economy, the global economy, cutbacks in spending by consumers here in the U.S. and across the globe. That's filtering, I think, into everything in every asset class that we're watching.
And also, I will add something. I know this is very, what's the word I'm looking for? Futuristic is if I'll be kind to myself. And Kane and I actually talked about this on Twitter a little bit. There is a secular demand away from oil. Like, more and more cars are becoming electric. Now, it's early. I know it's early. We're 5% of market. But trust me, it's doubling. 5% doubling in 2 years. 20% of all cars are going to be electric. I mean, maybe. But let's just imagine that's a real. That's so much demand taken off the thing that this thing, is not going to be able to get up. I'm hoping that's going to be the case, because then, it can't get off the ground. Obviously, it's great for a whole different things. Most importantly, it's great for us geopolitically, because the lower the oil is, the stronger America is. We're not, the only thing we're vulnerable to is high oil. We take that out, there's nobody that can touch us. And so to me, that's kind of an interesting trend that's really starting to happen. You're definitely seeing tons more Teslas on the, and Musk is now basically just, trying to give them away, right? He's really cutting prices.
Yeah.
And I think you're getting to a point where the production of all of this stuff, this is the other thing I don't understand. Electric cars are like computers on wheels, right? They have no moving parts. So once you figure out the production process, it's just inevitable lower cost. Just like the computer in the 80s cost $10,000, in today's dollars costs $500. It's possible that we could have a Tesla-like car for $10,000 5 years from now, which would be unthinkable in an age where most cars are like $60,000, right? So imagine these trends happening. Very bullish, ultimately, I think, for the economy, and bearish for oil, which is kind of good for all of us. But that's sort of like my longer term macro view.
Excellent. Thank you. So, guys, it's been a pleasure. I really appreciate you joining us on Friday. I know you guys have a big weekend, and next week, of course. Hope to see you both in Vegas. And just for the viewers, if you guys are just tuning in or late to the show, everybody who is in a Surge audition gets 30 days access to BK Trading. It includes the indicators, trading rooms, trading instruction. Check it out. You can find it on our website. You can find it in all of your email literature. So thank you guys again, and I hope you have a great weekend. We'll see you